91% of Americans have a bank account. Yet fewer than 4% actually understand how their bank makes money off of them. Let that sink in for a moment. You hand over your paycheck. You trust them with your life savings. And in return, they give you an interest rate so low it doesn't even keep up with inflation. Meanwhile, that same bank is using your money, your dollars, to generate returns that are 10 to 50 times higher than what they pay you. This isn't a conspiracy theory. This is just how banking works. And once you truly understand the mechanics behind it, losing money becomes almost impossible. Because you stop playing their game, and you start playing yours. Here's what most people think a bank does. You deposit your money, they keep it safe, they charge you a few fees here and there. And that's it. Simple, right? Harmless, even. But that version of reality is costing the average American household thousands of dollars every single year. Not in fees, although those add up too. I'm talking about something far more insidious. I'm talking about the invisible transfer of wealth that happens every single day between your account and the bank's profit sheet. The Federal Reserve reported that in 2023 alone, American banks earned over $260 billion in net interest income. That's the difference between what they earned on your money and what they paid you to use it. $260 billion. That's not coming from nowhere. That's coming from you, from me, from every person who deposits a paycheck and thinks the system is working in their favor. So why do most people lose money through banks without ever realizing it? It comes down to three things: financial illiteracy, misplaced trust, and the comfortable lie that saving money means you're building wealth. Let's start with financial illiteracy. The average American spends 16 years in school, 16 years learning algebra, history, biology, and not a single required course on how money actually works. You graduate knowing how to dissect a frog, but you have no idea what fractional reserve banking means. You don't know what the federal funds rate does to your purchasing power. You don't understand how a bank can legally take your $1,000 deposit and loan out $10,000 against it. This isn't an accident. The system was designed this way. Not necessarily through some dark conspiracy, but through sheer neglect. Financial education doesn't generate tuition revenue. It doesn't sell textbooks. And frankly, it creates consumers who ask too many questions. So the system just skips it. Then there's misplaced trust. We grow up being told to put our money in the bank. Our parents said it. Our teachers said it. Every commercial on television reinforced it. The bank is safe. The bank is responsible. The bank is where grown-ups put their money. And look, banks do serve a function. I'm not telling you to stuff cash under your mattress. But there's a massive difference between using a bank as a tool and surrendering your financial future to one because you never learned the alternative. And the third reason? The comfortable lie. People genuinely believe that having money in a savings account means they're getting ahead. They see that balance go up by a few cents every month and they think progress. But here's the truth no one wants to hear. If your savings account earns 0.5% interest, and inflation is running at 3.5%, you are losing 3% of your purchasing power every single year. That's not saving. That's slow motion erosion. Your balance looks the same. The number might even go up slightly. But what that money can actually buy is shrinking every single day. But that's not the full story. Not even close. Because once you understand how banks actually operate behind the scenes, everything changes. And I mean everything. So let me pull back the curtain. Let me show you exactly how banks work from the inside. And more importantly, how you can use that knowledge to make sure you never lose money again. The first thing you need to understand is fractional reserve banking. This is the foundation of modern banking. And almost nobody knows how it works. Here's the simple version. When you deposit $1,000 into your bank account, the bank does not put that $1,000 into a vault with your name on it. That's what most people imagine. A little safe deposit box somewhere with their cash neatly stacked inside. That's a fantasy. What actually happens is the bank keeps a small fraction of your deposit, usually around 10%, sometimes less, and loans out the rest, so your $1,000 turns into $900 of loans almost immediately. But it doesn't stop there. That $900 gets deposited into someone else's account, and that bank keeps 10% of that, and loans out $810. This cycle repeats over and over and over. Your original $1,000 deposit can create up to $10,000 in new money circulating through the economy. The bank earns interest on all of it. You earn interest on your original $1,000. See the asymmetry? You provided the seed capital. They grew a money tree, and they gave you a single leaf. The second thing you need to understand is the spread. This is how banks print money legally every single day. The spread is the difference between the interest rate a bank pays you on your deposits and the interest rate they charge borrowers on loans. Right now, as of recent data, the average savings account pays about 0.45% interest. Meanwhile, the average 30-year mortgage rate is hovering around 7%. The average credit card interest rate? Over 20%. So the bank pays you 0.45% to borrow your money. Then they lend it out at 7%, or 20%, or sometimes higher. That gap, that spread, is pure profit. Billions upon billions of dollars in pure profit. And your deposit is the raw material that makes it all possible. Stay with me here, because this next part is where it gets really interesting. The third thing you need to understand is that banks don't just lend your money to other people. They invest it. Banks take deposits and they buy government bonds. They buy mortgage-backed securities. They invest in corporate debt. They play the financial markets with your money every single day. JP Morgan Chase alone holds over $3.4 trillion in total assets. They didn't earn that by charging you $12 a month in maintenance fees. They earned it by deploying your capital into investments that generate massive returns, while paying you next to nothing. Think about that. You're essentially an investor in JP Morgan Chase. Without any of the upside. You take on the risk of depositing your money. They take the reward of investing it. That's not a partnership. That's a one-sided deal. The fourth thing you need to understand is fees. And not just the obvious ones. Yes, overdraft fees are a scandal. Banks collected over $6.1 billion in overdraft fees in 2022 alone. But there are hidden fees everywhere. Monthly maintenance fees, ATM fees, wire transfer fees, foreign transaction fees, account closure fees. Yes, some banks charge you a fee for closing your account. But the biggest fee of all is the one you never see on a statement. It's the opportunity cost of leaving your money in a low-yield account when it could be working harder literally anywhere else. The fifth thing, and this is crucial, is that banks are designed to keep you dependent. Every product they offer is engineered to create stickiness. Direct deposit, autopay, linked accounts, credit cards, mortgages. The more products you have with one bank, the harder it is to leave. They call this cross-selling. You might call it a trap. The more entangled you become with one institution, the less likely you are to shop around for better rates. The less likely you are to move your money. The less likely you are to question whether this relationship is actually serving you. Now here's where we flip the script. Here's where you stop being the product and start being the profiteer. Because once you understand these mechanics, you can replicate what banks do on a smaller scale. And that's when losing money becomes nearly impossible. Step 1. Stop letting your money sit idle. The first thing you need to do is audit where your money lives right now. If you have more than 1 month of expenses sitting in a traditional checking account earning zero interest, you're donating money to your bank. Move your emergency fund into a high-yield savings account. Right now, the best high-yield savings accounts are paying over 4.5%. Some are paying close to 5%. That's 10 times what the average savings account pays. This single move, this one change, could earn you hundreds or even thousands of dollars more per year depending on your balance. And the money is still liquid, still accessible, still FDIC insured. There's literally no downside. The only reason people don't do this is because they don't know it exists. Or because their current bank made it really convenient to stay. Step 2. Understand and exploit the spread yourself. Banks make money on the spread between what they pay for capital and what they earn on it. You can do the same thing. If you're borrowing money at 7% on a car loan, but your investments are averaging 10% annually, you need to understand the math. Paying off that car loan early might feel good emotionally, but mathematically, you might be better off investing the extra payments and earning 3% more than the loan costs you. Now, this isn't blanket advice. The math depends on your tax situation, your risk tolerance, and the specific rates involved. But the principle is the same one banks use every single day. Borrow cheap, deploy at a higher rate, keep the difference. Step 3. Make your money work in layers. Banks don't keep all their assets in one place. They diversify across time horizons and risk levels. You should do the same. Layer 1 is your checking account, just enough for daily expenses. Layer 2 is your high-yield savings, 3 to 6 months of expenses for emergencies. Layer 3 is short-term investments, money you might need in 1 to 3 years. Think treasury bills, certificates of deposit, money market funds. Layer 4 is long-term investments, money you won't touch for 5 years or more. This is where index funds, real estate, and retirement accounts live. Each layer serves a different purpose. Each layer earns a different return. And together, they create a system where every single dollar is working as hard as possible. This is exactly what banks do with their balance sheets. They just don't want you doing it with yours. But here's where it gets even more powerful. Step 4. Use debt strategically. The way banks do. Most people think all debt is bad. That's not true. Banks literally run on debt. Your deposits are their debt to you. And they use that debt to generate enormous profits. You can use debt the same way. If you're smart about it. A mortgage at 6.5% on a rental property that generates 8% cash on cash return. That's profitable debt. A business loan at 7% that funds a venture generating 20% margins. That's profitable debt. A credit card at 22% interest used to buy things you can't afford. That's destructive debt. The difference isn't the debt itself. It's what you do with it. Banks never borrow money just to spend it. They borrow money to invest it. Every single time. Learn that distinction and you'll never look at debt the same way again. Step 5. Diversify your banking relationships. Never keep all your money at one bank. Banks compete for your deposits. Use that competition to your advantage. Keep your checking at one bank that offers the best fee structure. Keep your savings at another that offers the highest yield. Use a credit union for your auto loan because they typically offer lower rates. Use a brokerage for your investments because they offer tools your bank never will. When you spread your money strategically, you force every institution to earn your business. You become the one with leverage, not them. Step 6. Pay attention to the Federal Reserve. This is something most people completely ignore. But it's the single biggest factor determining what your money earns and what your debt costs. When the Fed raises interest rates, savings accounts should pay more. Loan rates go up. When the Fed lowers rates, savings yields drop. Borrowing gets cheaper. Understanding this cycle lets you time major financial decisions intelligently. Lock in high savings rates when they're available. Refinance debt when rates drop. This is exactly what bank treasury departments do all day long. You don't need a finance degree to follow this. You just need to pay attention. Now let me show you what all of this looks like in practice. Let me give you a real example. Meet someone we'll call David. David is 32 years old. He earns $65,000 a year. Nothing extraordinary. Middle of the road. For years, David kept all his money at one big national bank. Checking account, savings account, credit card, everything in one place. His savings account had about $15,000 in it, earning 0.03%. Interest. That's $4.50 per year. Not per month, per year. His credit card had a balance of $8,000 at 21% interest. He was paying minimum payments, and his bank was charging him $12 a month in maintenance fees because his checking balance occasionally dipped below the minimum. David was losing money in 3 different ways simultaneously. He was paying $144 a year in account fees. He was paying over $1,600 a year in credit card interest, and he was earning almost nothing on his savings. Total annual loss, roughly $1,750 every single year. Then David learned how banks work. He didn't go back to school. He didn't hire a financial advisor. He just started paying attention. Here's what he did. First, he moved his savings to a high-yield account paying 4.5%. That same $15,000 now earns $675 per year instead of $4.50. That's a difference of over $670 for doing nothing but moving his money to a different account. Second, he switched his checking to a no-fee online bank. That saved him $144 a year in maintenance fees. Third, he used a 0% balance transfer offer to move his credit card debt to a new card with no interest for 18 months. He then set up automatic payments to eliminate the $8,000 balance within that promotional window. He saved over $2,000 in interest he would have paid over that same period. Fourth, he started investing $200 a month into a low-cost index fund. Over the next 30 years at an average return of 10% annually. That $200 a month becomes over $450,000. David didn't get a raise. He didn't start a business. He didn't inherit money. He just stopped letting the bank dictate the terms of his financial life. He understood the game, and he started playing it for himself. Within 1 year, David went from losing almost $2,000 annually to gaining over $800 in interest and savings, while building a long-term investment portfolio. That's a swing of nearly $3,000 in year 1 alone. Multiply that over a lifetime and you're looking at hundreds of thousands of dollars in difference. All because he learned how banks work. And that's the point of everything I've shared with you today. Banks are not evil. They're businesses. They exist to make a profit. And they are extraordinarily good at it. But you don't have to be their profit center. You don't have to be the one subsidizing their balance sheet while they pay you pennies. Once you see the system clearly, once you understand fractional reserve banking, the spread, the fee structure, the dependency model, you can't unsee it. And once you can't unsee it, you start making different choices. Better choices. You move your savings to where they're actually rewarded. You use debt as a tool, not a crutch. You layer your money across accounts and investments that serve your goals. Not the bank's quarterly earnings report. You pay attention to interest rate cycles. You diversify your financial relationships. You stop being passive. and you become strategic. This is not about becoming a financial genius. It's about understanding a system that was never designed to benefit you, and then designing your own system that does. Every wealthy person understands this. Every bank executive understands this. Every hedge fund manager understands this. The only people who don't understand this are the ones still losing money without realizing it. And after today, you are no longer one of those people. The gap between financial struggle and financial freedom isn't usually about income. It's about knowledge. It's about understanding where your money goes after you deposit it. It's about knowing that your bank makes 50 times more on your money than you do. It's about recognizing that every financial product you've been sold was designed primarily to benefit the seller, not you. Knowledge is the great equalizer. And the knowledge you gain today puts you ahead of 96% of Americans who still don't understand how their own bank works. So here's what I want you to do. Don't just watch this and move on. Take one action today. Just one. Open a high-yield savings account. Check your bank fees. Look at your credit card interest rate. Calculate what your money is actually earning versus what inflation is costing you. One step. That's all it takes to start. Because momentum is powerful. And once you take that first step, the second one gets easier. And the third. And the 10th. Before you know it, you've built a financial system that works for you instead of against you. If this opened your eyes even a little, hit that subscribe button. I put out videos like this regularly, breaking down the financial systems that most people never question. And in the next video, I'm going to show you how the wealthy use insurance products as secret investment vehicles that banks don't want you to know about. Trust me, you don't want to miss that one. Subscribe now so you don't. And I'll see you in the next video.